Good afternoon, everyone. Welcome back to the first weekly market review of 2025. I would like to wish everyone a very happy new year. And this year, again, we have with me Mr. Gerald Wong to share with us the insights on the market. How are you, Gerald?
Hi Sunny, hi everyone, Happy New Year. Yes, feeling very good. It is the start of a new year. And I think for this year, we have a lot of updates to be able to share with the participants in the weekly market review, as we learn more about some of the latest developments and how we can better equip ourselves for some of these changes.
Yes, I do agree on that. We do have a good holiday break, and now we are back in 2025. Santa Claus came, but then I think there wasn't really much of a Christmas rally, but I think most of the indices are still very close to the all-time high. So this year, I think it's a positive year again, and I think today you will share with us the updates in the last couple of weeks.
Yes, that's right. As usual, we'll start with the disclaimer. So this hasn't changed even though we are in the new year. Whatever that we are sharing today is for information purposes only and should not be taken to be financial advice. Okay, if you find the weekly market review helpful, if you have been following us for the past year, or if you are new to the weekly market review, you can leave us a review on Google, either by scanning this QR code or going to this URL. Next, if it is your New Year resolution to be a more educated and informed investor and would like to consider joining SIAS as a member, you can scan this QR code here. And as a SIAS member, you'll be able to access various online resources as well as investor education programs. Okay, so we start the recap on the past week. It is a short trading week. And what we see as a start to the year is that the various stock indices were mixed over the past week. The S&P 500 was down slightly. But then in Singapore, we actually see that the STI was starting the year on a strong footing with a 0.8% gain over the past week. Okay, if I were to look at why the Singapore market has done well, one of the key data points that came out over the past week, which is good news for the people who are actually in Singapore here, is that the 2024 growth actually beat expectations. Okay, so according to the number that was announced, Singapore's economy grew by 4% in 2024. So this was actually above what we see here as the forecast. And at the same time, if you're to look at how that has trended over the past few years, in 2023, Singapore's GDP grew by 1.1%. Okay, so this actually represented the highest growth over the past few years. It was only in 2021 that we saw a stronger growth because that was the post-COVID recovery that actually boosted the economy. Once again, if I were to compare the 4% growth in 2024 versus the historical average, then once again, that is above the norm in the past. Okay, so we see here the quarterly trend in the third and fourth quarter of this year. The growth actually picked up compared to what we saw for most of 2023 and the first half of 2024. So there was improving momentum towards the second half of 2024. Okay, so this is another way that I'll look at it. This was the MTI's previous forecast. They were previously forecasting that Singapore's growth would be close to 3.5% for 2024. So that was above the official forecast. And going to 2025, the current expectation would be for growth this year to be in the range of 1 to 3%. Okay, so some moderation in growth expected in 2025. And the key reason for that is mainly due to the various risk factors that economists see for the global economy. So one of them would be the change in the US president and how that would actually lead to potential policy change, whether is it in the form of potential tariff or whether that is going to lead to more volatility and uncertainty in the global economy. Okay, so if I were to look at the performance of the STI, what we saw is that Seatrium did very well in the past week with a 7% gain. We also see oil prices now at a 2-month high. So that is actually helping to improve the sentiment towards some of these oil and gas related stocks. Okay, outside of Seatrium, we see some of the REITs having a slight bounce in the past week. CapitaLand Ascendas REIT up by 2.7%, Mapletree Logistics Trust up by 2.4%. And I'll share a bit more about the REITs later, given that this is a topic that some investors have asked us about over the past few weeks. Okay, in terms of worst performance, we see some stocks with slight losses, not significant. So Jardine Matheson with a 1.1% decline, Venture with a 0.7% decline, and then a few other names that were down slightly or about flat over the past week. Okay, I wanted to discuss a bit more about the REITs because one of the commonly asked questions that we have had would be why have the REITs actually been so weak, even though we have seen the Fed cutting interest rates over the past few months. Okay, because I think the general perception is that if the Fed were to cut interest rates, that would generally be positive for the REITs. But as what we have seen here for one of the REIT ETF, which is a basket of REITs in the Singapore market, what we do see is that following the Fed rate cut, there has been a decline in their prices, despite the bounce that we have seen over the past week. Okay, so what we're trying to understand is that why is that the case? Okay, so I think what we have been going through in the past weekly market review that you might be familiar with is that the US Federal Reserve has actually cut interest rates by 3 times since September last year. And we have seen the benchmark rate coming down by 1 percentage point, effectively over the past few rate cuts. Okay, so that is driven by the easing of inflation that we have seen that has allowed the Fed to be able to bring down the interest rates. But what is still noteworthy is that despite the cut in interest rates, it is still at a fairly elevated level, and we are nowhere near where it was in 2021, where the interest rates were actually close to 0%. Okay, and heading into 2025, the expectation is that there will be potentially more rate cuts, but the extent of the rate cut is going to be fairly limited. Okay, so I updated the CME FedWatch 2 last night, and what we do see here is that for the upcoming meeting at the end of this month, investors are just expecting that the Fed will maintain its current benchmark rate, and that we might only see one further rate cut this year happening in May this year. Okay, so while we have seen rate cuts in 2024, the expectation going to 2025 is that we may not see significant further rate cuts. Okay, so what this means is that if I were to look at US government bond yield, and this is the 10-year bond yield, which represents expectations of longer term interest rates. The US 10-year government bond yield has actually increased following the Fed's rate cut. Okay, so if I were to look at it, the bond yields declined in anticipation of the rate cut. But since then, if I look at from September onwards, it has actually bounced from 3.6% to now 4.6%. Okay, so that is close to a 1 percentage point move in terms of the US 10-year government bond yield. Okay, and that is actually impacting the sentiment around the Singapore REITs, given that investors may view that there are other instruments that can offer a better return, such as government bonds. Okay, likewise, if you were to look at the Singapore 10-year government bond yield, we also see a similar bounce since September, even though it is not as significant as what we saw for the US 10-year government bond yield. Okay, so increasing from about 2.4% to now about 2.9%. Okay, on a more positive note, we have seen that some of the shorter term interest rates have actually started to decline. Okay, so this is the Singapore overnight rate average. For some of you who have property loans, you might be more familiar with this benchmark rate. Okay, so previously we are looking at the 10-year US government bond as well as the 10-year Singapore government bond. Here we look at something that is shorter term in nature, which is the overnight rate. And the more positive sign here is that with the Fed short-term rate cuts, we have also started to see a decline in the Singapore overnight rate average. So what will this mean for the Singapore REITs is that for some of the REITs that may have loans that are due for renewal in 2025, what we have seen is that as some of these short-term rates actually start to come down, they may be able to refinance their debt at a lower borrowing cost. Okay, so how does that translate to the prices of some of the Singapore REITs? I'll use two examples for today's weekly market review. Two names that many investors are commonly asking about. The first one is CapitaLand Integrated Commercial Trust. What we see here in terms of the movement of the REIT price is quite similar to what we saw for the REIT ETF in that it had a bounce going into the Federal Reserve rate cut, a slight correction with the bounce in the 10-year government bond yield in Singapore. Okay, so on the other hand, if I were to look at the distributions of CapitaLand Integrated Commercial Trust, it declined in 2020 because of COVID, okay, has rebounded steadily over the past few years, and the expectation is that it might actually increase further in 2024. Okay, so with that, we are looking at a dividend yield of about 5.6% for CICT. If I were to look at the valuation of CICT today, price to book of 0.92 times, this is above the historical average of CICT, but still slightly below the sector average price to book of about 1.1 times. Okay, I mentioned earlier that the dividend yield of CICT is 5.6%. That is actually above the historical average dividend yield of CICT. And that is mainly because, as we have seen earlier, the REITs distributions have actually increased and continued to recover after the post-COVID decline. Okay, so at this point in time, offering a 5.6% dividend yield, which is above the historical average. Okay, next I'll look at Mapletree Industrial Trust, where the share price has effectively moved quite in tandem with what we saw earlier for CICT, and that is why interest rates is such an important thing to track to understand how the movements of different REITs might actually trend over the next few months. Okay, for the distributions of Mapletree Industrial Trust, a bit more volatile compared to what we saw for CICT. Okay, so at this point in time, the expectation for the upcoming year is that we might see a slight recovery in the distributions, which might bring the dividend yield of Mapletree Industrial Trust to close to 5.7%. Okay, if I were to look at the price to book ratio of Mapletree Industrial Trust now at about 1.3 times, which is above the historical average. And then if I were to look at the dividend yield of Mapletree Industrial Trust, it is close to the historical average. Okay, so compared to CICT, which actually has a price to book ratio of below 1 times, dividend yield that is above the historical average, what we see for Mapletree Industrial Trust is that the price to book ratio is actually higher than the historical average, and the dividend yield is actually closer to the historical average as well. Okay, in terms of what to look out for in the upcoming week, we are still in a relatively quieter period in terms of the economic releases as well as the earnings releases. But what I'll be looking out for will be the US jobs data that's coming out this Friday, the 10th of January, as well as the US Federal Reserve meeting minutes that's coming up on Thursday, 9th of January, because those will provide some indication as to what will the Fed be doing in the upcoming months. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thanks, Gerald, for that updates on some of the movement in the Singapore market. I will start with the STI index first. So the STI index in the past 2 weeks has been on a very healthy uptrend. We are up 0.8% as what Gerald said earlier. And the week before, in the last week of December, we are up about 1.39%. So you can see here, STI is actually on a strong short-term uptrend that we are seeing. Okay, the high that we are targeting is still the early December high at 3,842 points. That will be the first resistance to look out for, and that coincides with the upper bound of the Bollinger Band now at 3,836 points. Okay, so if you are looking at getting into the STI index today, you may consider the 20 days moving average, which is the Bollinger Band basis at 3,787 points, or even the lower bound of the Bollinger Band with now find confluence with the 50 days exponential moving average at around the 3,760 points, the 3,738 points, and 3,730 points. So we round it off to 3,730 points for a key support level. So like what Gerald said earlier, there wasn't much of a major economic news that was come out. Trading volume in the past 2 weeks definitely was thin because of the holiday period. So definitely you will not see much of a big fluctuation over here. Okay, so I will still think that if let's say it's go back down to the 50 days moving average, that would be a good point to accumulate on the STI index. Looking at the indicators, we can see that the MACD is showing signs that the MACD line, the black line, is converging towards the signal line, and we could have a breach above the signal line very soon. Currently, it is still slightly negative. So once a crossover happens, it may signal the start of a new uptrend. Okay, so what we are seeing right now on the MACD indicator or the MACD histogram is that the downtrend that we see in the middle of December is actually subsiding, and we are actually on a possible new uptrend once the MACD confirm a crossover and turn positive. Okay, and that could happen very likely next week. And the RSI is now reading at 60 points. So 60 points is a healthy reading above the 50-point neutral mark, 10 points below the 70-point overbought mark. So there is still room for the RSI to go up further before it hits the overbought condition at the 70-point mark. So the RSI has also went up above its 14 days moving average, which is the yellow line that you see here. So that is another good sign that momentum is building up on the STI index going into 2025. So things are looking good on the STI, around the 20 days moving average, 50 days moving average. Those are the key support levels that you can look at on the STI to get back in on the STI index. Okay, next, let's move to the US indices. So you can see that although we started the year in the US on a negative note, in the sense that we have a sort of a negative week in last week for the US indices, but last Friday we saw the ISM manufacturing PMI data, which was a positive reading, stronger than consensus and expectation. So we have a jump on Friday on the US indices. The Dow Jones is up 0.8%, S&P 500 and NASDAQ is up more than 1%, and in fact NASDAQ is up closer to 1.8%. Okay, so you can see that the Dow Jones Index, it has retraced back towards the 100 days exponential moving average, which is the amber line over here. So this is a very good support level, and we are still very close to this level right now. So this is actually a good opportunity to start the year if you're looking at the Dow Jones Index, to get in around the 100 days moving average, which is now around the 42,500 points level. Okay, so resistance, nonetheless, we are still looking at the all-time high of 45,073 points. So 45,000 is a very strong handle to look at. And then you can see that some of the moving averages, the 20 days and the 50 days moving average, is starting to trend down a little bit. But if we look at history, once you can see that it starts to trend down a bit, once it hits the 100 days and the 200 days moving average, usually it will bounce back up. Okay, so this is these are the things that we are monitoring. And on the indicator side, the MACD behavior is similar to the STI index, although it's not as smooth as the STI index. the MACD we still have a negative reading on the MACD indicator, but that negative reading has been subsiding in the past 1 week at least. So we still have a gap between the MACD line and the signal line. So there will not be an immediate rebound in the Dow Jones Index yet until the gap between the MACD line and the signal line starts to converge and get smaller. Okay, and then once a crossover happen, is the resumption of the uptrend to retest the 45,000 handle. On the RSI, we actually hit the oversold condition somewhere in the middle of December, where the RSI went to 29 points, and that is where we first tested the 100 days moving average in the middle of December. But because there wasn't much of a news or happening in the past few weeks or the last second half of December, so market did not really move very much, and we are now back down closely. And the latest RSI reading at 41 is slightly weak, but it has crossed over its 14 days moving average of 39 points. So once it crossed above the 50-point mark, we would likely expect some sort of momentum starting to build up again on the Dow Jones Index, and that we can see a rebound from the 100 days moving average of 42,500 points to the 45,000 handle on the Dow Jones Index. Okay, next, let's move to the S&P 500. So S&P 500 performed well on Friday. We had the stronger US data that I mentioned earlier. So it is building on that support. We tested sort of the 50 days moving average. We actually breached that level, and we are actually approaching the 100 days exponential moving average in the later part of December. But then that was supported by the lower bound of Bollinger Band. So we did not really touch that level, but this is the level that you should be looking at. If there may also be a sort of a double bottom formation over here, which you can consider. And if I'm going to draw a line across that, that could be around the level of 5,878 points, which is not too far off last Friday closing of 5,942 points. So resistance-wise, we are still looking at a high of 6,099 points, which was the high that we saw in December. 6,100 is the immediate resistance level we are looking at for the S&P 500. Looking at the indicators, we can see that compared to the Dow Jones Index, the S&P 500 is slightly more negative because it is still in a downtrend, and compared to the Dow Jones Index, the reading is slightly more negative. So the downtrend momentum is still more prominent in the S&P 500 index, according to the MACD indicator. And it does not look like we are going to have a crossover or a positive reading soon on the MACD indicator. So likely the S&P 500 will be range bound till we have the next catalyst, which could come in the form of the non-farm payroll data this Friday. On the RSI, the latest reading at 47 is still below the 14 days RSI moving average of 48, below the 50-point neutral mark. So momentum is weak, so don't expect a quick rebound on the S&P 500 yet, or a sustained rebound on the S&P 500 yet, but definitely the lower bound of the Bollinger Band here at 5,835 points, that could be a good accumulation level, and further supported by the 100 days moving average, which is at the 5,800 points for the S&P 500 index. So 5,800, 5,850 points, that will be a good level to get in on the S&P 500 index. Lastly, let's look at the tech-heavy Nasdaq Composite Index. So actually, the consumer discretionary sector was the leading sector on last Friday on the S&P 500, where the consumer discretionary sector gained about 2.4%. The next bright spot definitely is the tech sector. We saw Nvidia up about 4.7%, if I recall correctly. And I clearly remember Supermicro Computer actually gained 10.9%, so that's double-digit percentage gain. So actually, tech stock did have quite a good rebound on Friday. And you can see that the Nasdaq Composite Index, being a tech-heavy index, is using the blue line, which is the 50 days exponential moving average, as a very strong support, as what we see in the November period as well. So I believe this level, the 50 days exponential moving average, which is at 19,245 points, with the lower bound of the Bollinger Band at 19,200 points, will be a very good level to accumulate on the Nasdaq Composite Index for now, to target the high in December at 20,200 points, around there. Okay, so that will be the range that we are playing at, 19,250 points level towards the 20,200 points level. On the indicator wise, we can see that the MACD at least is still showing a prominent negative momentum or downtrend momentum. So that means that there will not unlikely be a very big rebound soon. And on the RSI indicator, we can see that the latest reading at 52 is slightly above the 50-point neutral mark, but then it could likely challenge the 14 days moving average at 55. So that could maybe smoothen out the momentum around the 50-point level. But that is encouraging sign, because if the reading is above 50, definitely that is a positive reading, okay, above the 50-point neutral mark, and that could mean that there may be some small uptrend momentum coming in soon, waiting for the MACD to confirm that. And then we could be on another good run up on the Nasdaq Composite Index again. So rounding off 2024, the S&P 500 was up 23%. This is the second consecutive year that the US broad index is up more than 20%. And I have been reading some of the major projection or forecasts for the S&P 500 for 2025, and most are in the around the 10% region. I remember Goldman Sachs was saying 11%, or UBS and Goldman Sachs are saying 11 and 12%. So we are expecting a high single digit or low double digit kind of growth in 2025 for the S&P 500 index, which is still a positive reading, but definitely to repeat what we saw last year will be a challenge. So still looking forward to another positive year, and you should start learning investing and start getting invested for the better 2025. Okay, so these are my updates for today. Anything else to add, Gerald?
Yes, thanks, Sunny, for highlighting the importance of staying educated, being invested. And I think that is something that we hope to be able to share with various participants over the course of Weekly Market Review in 2025. So with that, hope to be able to have your participation in our future Weekly Market Reviews as we provide you with more updates around the financial markets.
Yes, so a great start, not too bad start to the year of 2025, and I believe 2025 will be another great year with more growth to come in the market. So I wish everyone a very happy new year again, and we hope to see you next week in our next weekly market review. Okay, goodbye.
Thank you.